Hey, good afternoon, everyone. Hello? Are you guys there? I have two people in this session. Hi,
Yes, we're
Jaming.
here.
How are you, Stacy?
I'm
Did
good.
you guys sign into today's forum? I checked out today's forum, and there was only one person that was signed in. But you got to remember that that's your physical proof of attendance. So you gotta establish your own. You're responsible for establishing your own proof of attendance, right? That's the first order of business. So please, if you haven't done it, please, go back to the discussion board, today's forum. And I see you there. I see Jamming there. But I don't see Stacy there yet. So Stacy, don't forget to
It's not
sign in.
letting me create the thread.
How come? It
I don't
should.
know.
I mean, let's see. But you must, because otherwise there's no proof of, there's no physical proof of your attendance. So I'm sharing my screen. Okay. Are you here? Are you in?
So I go to the discussion board. Hold on. And it just shows me like total posts, unread posts, but nothing else. And it's not letting me create a thread at all.
So you don't see this button? You don't see this link?
It
Do
it
you see?
doesn't. There's nothing that says create a thread. It just says reply or something like that.
No. Can you? That's weird. Can you refresh? Would you refresh the screen? Refresh the browser and see what it. Sometimes, are you using a computer or are you using a phone?
Computer.
Computer. So there should be no problem.
Let me see.
Did you refresh the browser?
Yeah, I just did that right now. Still
And
nothing.
then, does it work?
No, all it says is a reply. Nothing about creating a thread.
But you see this link. Do you see this? Do you have this?
No,
You don't have that.
no.
That is but you see everything is like this.
Yeah.
You see the list of people here.
Yep.
Well, it could be your browser issue, right? If you don't, it could be your browser issue. I mean, I don't know what kind of browser you are using, but if you change the browsers, I mean, what browser are you using?
Right now, Safari. But
Safari.
like,
So you use Apple. Yeah,
it's
but
just
do you have something like Chrome or um, Chrome or Firefox?
no,
And
because I have a
sometimes
Mac computer.
you have
Mac.
what?
I have a MacBook.
Yeah. Even if you have a Mac, you can you can download a Firefox or Chrome. It's just a browser. So sometimes the you need to update the browser. Maybe you need to update Safari, and then it would work. Sometimes you don't see. I don't know why that isn't. But I normally okay, so if you can reply, do it. At least leave your proof of attendance here. Okay, like this person. But this is not recommended because it won't be seen from outside. And if you're not seen from outside, you won't be counted, right, for presence. Now, All righty. So we have currently 10 people, including 11, apparently, considering Stacy and the gentleman who just, posted, replied to my thread. But I see only 6 here in the collaborate session. And people think that they don't have to come to collaborate session if they are okay with the main lecture. But still, you will be missing chances to earn participation points. If you're not in the collaborate session. Now, so anyone here hasn't yet reported attendance in today's forum? If you haven't, please, Dexton has, Don is separate here. Good.
Right, I found what I was missing.
Who said what? There were two different voices, right?
I just made my own thread right now.
You're creating your own thread right now? Good. Okay, good. Oh, that's good, okay, so it's gonna, I'll check later, because if you're in the middle of doing that, right? All righty, so where was I? So in the last class, we didn't do much. It was just a intro, right? I gave you a tour of, I gave you a tour of the structure and configuration of the blackboard, and not more than that. We haven't even got started. So actually, it's today's class is the first in terms of in terms of the contents and the topics, right? But before that, let me quickly okay, Stacy, you're there. And then if you go to course material, right, you will find basically, the main lecture videos. I've been telling you, I told you that collaborate session is not the main lecture. A collaborate session is only like the afterglow, where we review and reflect on the main lecture. So as of last Thursday, these 2 videos were assigned. So you should have watched these videos, at least, over the weekend. And we have, 4 videos, 3 videos were assigned. 3 more videos are assigned today. So we're gonna get back to. I'm gonna get to that, and then the last session recording was posted here, and someone was always someone was asking. There was nothing in the assignment. There's nothing in the assignment yet. No assignments just yet. When I say assignments, that's basically a test. It is already, they are all built in there, but it's just not visible to you, because
the complete breakdown. The complete breakdown of the attendance that wasn't supposed to.
No. That is yeah. That's not okay. That may be visible to you, but that is not. That doesn't. That is just an example, because you don't have grade. You don't have semester grade. You don't have attendance. But if you download it, you will see it is from some, previous semester, right? It was just to give you an example to show you how your grade is um, calculated and how um, it is constructed, right? So actually, I don't know if I did talked about this, yes, the last time. Um, so let's take a look at this one. Um, this is summer. This past, this summer, summer two. So summer two was a little um, different because it's only 5 weeks, and the class met every day for 2 hour 30 minutes every day, 4 days, Monday through Thursday. So 5 weeks. So that's 4 times 5, so 20 sessions, right? So basically, 5 points for class attendance, and so 5 divided by 20. So attendance every day was 0.25, right? 0.25 points. And you can tell some people got, more than 0.25. That means, that was, participation point, right? And what is 0.1? That was late, right? And then, so basically, the total, someone had something like 9.25, right? And that's not even, the best. Someone had 17.5. What does that mean? This person had perfect attendance of 5 points plus 12.5 of, participation points. So how that worked out, let's take a look. So quiz one, midterm, quiz two, final, 4 exams, right? And quiz one and quiz two are 20%. Midterm and final are 25%. So that may not be very, okay, may not be quite. So I think this is, big enough. So according to that metrics, or according to that formula, you got, that was exactly calculated that way. 20% quiz one, 20% of quiz two, so sum of those two numbers by 20%, and then 25% of midterm and final, and then F2, which is attendance, that, a full, the whole, 17.5 entered that formula, right? So this person, actually, there were people who did better than this person in terms of only exams, right? This person didn't ace the final, didn't ace the quiz two. This person clearly aced the midterm, but not aced, this person didn't ace the quiz one, but thanks to the participation point, nobody had 17.5. But thanks to the participation, that more than, compensated for the shortcomings in other. I mean, this person generally did well, right? It's clear this person did well. But this person didn't ace in every exam. But, by far, in terms of participation, this person outdid everybody else, right? And so this person got the mean of the weighted average was 73.5, which was relatively higher than historical average. Historical average is about 68, 70, but and standard deviation was 24. This was also a wide standard deviation because, look at the bottom, someone who got This person is not included because this person didn't do anything, right? In calculation of the mean and standard deviation, this person wasn't included because this data is. But this person was included because at least this person gave quiz 2. So I had to then look at the range. The range was very wide between 16.7 and 99.63. So obviously there's wide range of data, so the variance and the standard deviation would be big, but the whole distribution is skewed upward a lot because obviously you can tell because the mean is relatively high. So a lot of people got look. This is a small sample. Small sample doesn't, exactly follow the normal distribution characteristics, but you can tell at least 78% got C plus or above. Actually, there was no one who got C plus, so that was same thing as B minus. 78% got B minus or above. Which is like 8 out of 10 people. This is cumulative percentage, right? 6% got A, another 6% got actually another 6% got A minus. Cumulative percentage is 12%. You might wonder why is it not 12? Why is it 11? These are all numbers are rounded. So if you expand it, it would be 5 point something, obviously. Now, so cumulatively, 3 people out of 10 got B plus or above, right? And cumulatively, 8 people out of 10 got B minus or above. And then actually, I made some adjustment. I made some adjustment later on because if this person was just marginally below the cutoff line for A minus, that was not even 5% margin. That was okay. It was 91.50. So it was even within 0.5 range. So I bumped him up or her up to A minus. This person also marginally, below B plus, really marginally below B plus. So I bumped him up or bumped her up. This person also was marginally below B. I bumped him up. And these people were below B minus. And for those people, I used, there were 2 tests that were taken earlier in the semester before the quiz 1. So the better of the two was used to supplement. For example, this person had 0, or that's either literally got 0 or no data, right? No data. And of course, it was no data. I mean, if he or she did that exam, it could have been something, some positive number, not completely 0. So that's no data. In this case, I used, the extra. These were actually, self-test, practice tests. They don't normally enter the semester grade calculation, but I used it 75 that person got. So it was either this person or this person or this person, I think. But of course, by checking the other scores, you can tell this person didn't have quiz 2, so it was this person. Okay, so using that instead of, so this replaced this blank, right? Missing data. So, after substituting that for that, this C minus was boosted to C plus. It's not manually done. You think I just, manually looking at that grading criteria and I manually do that? No. I have algorithm of my own to automatically assign the grade. And, these, grade cutoff lines were based on certain, metrics. So it automatically, it's all done by the algorithm. Now, so this is the sample. I mean, that complete grade breakdown. It wasn't this one. It was from like fall 2020 or something like that. So that would look, but that isn't the most latest, because in fall 2020 I didn't use participation point. Okay, at the time I didn't use. So basically the attendance was just very boring. Either you were present or absent or late. And if you were present, you got a certain point. If you were, if you were late, you got a certain point. And if for absence above 3, right? For more absence than more absence than 3 absences, right? There were penalty, right? And there was no participation point. So there was hardly any way of boosting your grade just in case you didn't do well in the exams. So this sample doesn't really fit well with the current class, because you will be more, for you, there will be lots of other practice problems, because it will be on Connect. And during the summer, I couldn't use the Connect because it was very short, right? Summer 2 was just 5 weeks, and there was no time for any chapter practice problems, on Connect. But during the regular semester, there were more, right? There will be more. So anyway, let's go to, without further ado, let's go to, the first topic is return on investment, right? And return on investment is probably the single most reason that the single most reason that everyone wants to learn finance, right? Especially in investing, right? What else matters? Nothing beats the highest return on investment, right?
Gotta pump those numbers up.
Hmm?
Gotta pump the numbers up on a return on investment.
Actually, return on investment, yeah. Well, when you say pump up the numbers, that is more like a market manipulation, right? Don't you think? Pumping up the numbers. Yeah, but that is market manipulation. For example, Tesla had a very good year, 2020. Okay, I think you need to mute your microphone. okay, because a lot of background noise is interfering, and also my voice is being echoed back, right? So you have a very good microphone, because usually, external um, external sounds, even coming from the computer, is not well received by the microphone. You know what I'm talking about? When I play something, when I play a video on, when I play a video in the Blackboard, right? The video has a sound, and that sound will be, that sound will come out through the speaker of your computer. But inevitably that sound will be also picked up by the microphone of the computer. Then the sound from the video being played in the Blackboard will be rebroadcast, right, in the Blackboard again. In other words, it's being echoed. But usually you have a very dim, right? That sound will be very dim, because if the microphone is not picking up that sound from the computer well, then it's not feeding back into the computer that well. So it's usually not, it's usually dim, because it's not rebroadcast. It's not rebroadcasted well. So my microphone is basically like that. It's not picking up the sound being played from the computer that well. It picks up my voice because I'm speaking from outside the computer. I'm speaking into the computer, and that microphone is picking it up. But if it is the sound being played from the computer, my microphone doesn't pick it up very well. But sometimes I hear my voice being echoed back very clearly from somebody's microphone. That means that person has a very good microphone, built-in microphone, or I don't know, additional microphone, whether it is an additional microphone. But anyway, yeah, you gotta, I keep hearing this thing, if you're trying to say something, please keep in mind, I can't see it while I'm looking at something else. So I think it's going on behind, okay, I think there's something going on between you guys.
Professor.
Yeah.
I have a kind of like a stupid question.
Yeah, go on. Yeah.
So
no question is a stupid question.
So with
Yeah.
the Excel assignment, when you say we have to put exactly
yeah. Okay, one thing. The assignment is, some people were asking, do I need to submit it? No, you don't have to. All you need to do is just reproduce the same. Look, when you download that Excel file, right? When you download the Excel file, it will have everything is already filled in, right? But what you need to do is delete everything except the initial data. Of course, you need to have initial input data. There should be initial input data, right? So you gotta delete these, and delete all these, and you don't have to delete this, but you can tell whatever you get here, it will be automatically reflected here, right? So, but delete the rest of them, and work out, replicate what I demonstrate in the video. And if you get the same result, right? If you get the same result, then that checks out. That means your work is correct, right? Does that make sense? So yeah, it's basically self-confirmation. I mean, if you got it right, you know whether you got it right or wrong, right?
So we don't have to send it to you.
No, you don't have to send it to me.
Okay.
It will be all tested later. I can't, I have 4 classes of 4 sections of FnB100. If everyone sends all that to me, I'm simply, I will be swamped with, just I can't go through every one of them. Okay. So where was I? I was talking about, yeah, pump up the numbers. That you got to be careful about, because if you the price is that's market manipulation. You pump up the numbers, pump up the stock price. Look, that means
Have you
people
heard of
are
Wall Street bets?
Hmm?
Have you heard of Wall Street bets?
Yeah. They pump up
Yeah,
they
that's
pump up the
insane.
GameStop,
They pump the
right?
numbers. You got to pump their numbers up. You got
Yeah.
to get a
That's a
million.
good. In that case, that's not a bad thing. But still, it's a market manipulation. They did it to thwart the short sellers, right?
Retail
And
finally has a chance.
yeah, in other words, most people are long on any stock. Think about it. Most people are individual investors, and um, individual investors are uh, just going long. They
You
are
can
they are
you can
buying
say it.
stocks.
You can say it. They call us dumb money.
Well, yeah, again, yeah, from the short sellers, or from institutional investors, or from hedge funds who manipulate the market. Yeah, average, individual investors are cannon fodders. You understand? They use these individual investors as cannon fodders, nothing but cannon fodders. You are nothing but uh, the uh, you're nothing but a what do you call that? You're nothing but a game in there. You're nothing but a game in their uh, foul play. You're nothing but a game in their uh, hunt, or you're nothing but a what do you call that? Rook.
In their predatory investing, because that's what it really is. It's predatory
Exactly. You're
investing.
nothing but the rook in their chessboard, right? In their chess game. You're nothing but uh, dispensable, right? What is the uh, if it is not queen or knight or king or bishop, what is that
It's the
called?
pawn.
Rook?
The
It's called a
pawn.
pawn, sir.
Yeah, you're nothing but a pawn in their chess game, right? And institutional investors who mobilize a huge amount of money, right? Uh, they they are the ones who manipulate the market, right? They pump up the price and they sell off. And those individual investors who are holding on to those, just because the price is soaring, they are happy, and they
They
are
become bag
uh,
holders. They become bag holders ultimately. But
yeah,
my real
yeah.
question is, do you think
They
we are in a
jump into
similar
the bandwagon,
situation?
and yeah, they become back holders, and when the price plummets, they take the dive, right?
But do you think we're in a similar situation to Volkswagen when it short squeezed before in the 2008 financial crash with AMC and GME, with all the short selling that's going on, the naked shorts out there? Do you think that's something similar?
Uh, yeah, I don't know. I don't remember exactly what was the deal with AMC, but whenever there was um, uh, attempt to short, right? And it's constantly happening by the hedge funds, right? Or by big money movers. It's the same situation over and over, but only once this time, once in the history of the financial market, the retail, so-called, what you call retail investors, right, defeated those, short sellers, right? That was the uh, and so think about it. They talk. the retail investors taught them a lesson. You cannot take us for, you cannot take us for a ride, right? Every time, whenever there was a financial crisis, and especially if it was due to the, attempts by short sellers, institutional short sellers, the retail and individual investors, the retail investors were taken for a ride, right? But this time, they really, the retail investors really, what should I say?
What are your thoughts on Melbourne Capital losing 49% of their basically income or revenue stream, I should say, or capital, if we should go into that in first quarter? First quarter, they're down 50%. Plotkins, Melbourne Capital.
Melbourne Capital? Did you say Melbourne Capital?
Melbourne Capital, Citadel, they're down almost 49% first quarter.
Well, obviously, I don't know about Melbourne Capital, but if they lost 49%, of course that's significant loss. I mean, I don't know what caused that, because I didn't read about Melbourne Capital.
They have a large position. They have a large position in GameStop and AMC, and it's
so they are the one. That was last year. That was last year. They were the short sellers.
Yep.
They were the guys at the other end. Well, good for them. Good for them. Those, predatory, those predatory short sellers, those predatory hedge funds, they should be taught a lesson.
Exactly. That's something that needs to happen, because they can't, the same way you say.
Of course, that should happen more often, so that
for us, for the retail investors.
Yeah, if they are trying to take advantage of the normal workings of the financial market, and they are the ones who are trying to take advantage of. They are trying to benefit themselves at the expense of the rest of the financial market, or the economy. I mean, think about it. Those short sellers, those hedge funds, those institutional investors, they don't care whatever happens to the economy. Right?
And it's so scary, because at any moment they can change the rules to benefit them. When retail market manipulates the market the same way they have, they want to change the rules.
They try to justify short sell, by saying short sale provides liquidity to the market, blah blah blah. Well, a small pocket of short sales, that's small pockets of short sales. That's fine. I mean, that may serve, that may serve in a positive, role for the financial market. But a massive scale, short sale, just to predatory, predatory short sale on a massive scale. That kills me. Yeah, that brings down the economy.
I got a question real quick.
Okay, hold on. Someone else? Is it a different person?
Yeah, I got just a quick question. Are we supposed to be listening to this, or are we supposed to be watching those 3 videos and then doing that assignment thing that you said to do in the discussion board? Or are we supposed to be here?
Well, as I said, the collaborate session is not the main lecture. The collaborate session is more like an afterglow. So if you think you can do without this afterglow, right? Because we are mostly reviewing and reflecting on the main lecture. You can skip this and go to the assigned videos. But again, you can also watch the assigned videos in your own time. I mean, you have plenty of time, like between now and the weekend. I don't know if you have. I cannot speak for you. Whether you have plenty of time. Okay, if you don't have plenty of time, yes, use this time to watch those videos now. Okay, But as I said, I post those videos for 5 days. So if you miss it now, then you can watch it later, whenever, over the weekend, or even, later today, tomorrow, or, whenever you get a chance. But if you have, um, uh, decent amount of time, you can replay it as many times you can, and until you fully comprehend and digest the material. Okay, so
All right.
yeah, you may you may be excused from the collaborate session, but don't forget to sign into the don't forget
Discussion
to
board, right?
yeah. Is it Dexton?
Yeah, I did.
Okay, alrighty, Dexton. Now you may be excused from the collaborate session. Alrighty, so without further ado, as I said, most people, individual investors, have only simple strategy: buy and hold, right? It's called long strategy. And if the economy is growing, and if the company that you are holding is doing well, your position will, your holdings will increase in value. Okay, and uh, before Dexton, who was that I was having conversation with?
It was me.
Who,
It was
who was
Peter.
talking about Wall Street bets?
It was
Mhm.
Peter.
Peter.
Yes, yes,
Okay, Peter Moore. All
yes.
right.
I actually wanted
Yeah.
to know if you feel, because your thoughts just now were, as you hold, the longer you hold the security, over time you'll see your profit grow. So, assuming that they cover their positions because it's a heavy loss and they're trying to hedge, do you feel as if that would help us attain a squeeze?
That will help us. What?
A short squeeze, like a short squeeze going into
Um.
the.
Yeah. Well, of course, to avert a short squeeze, to avert a short attempt, there has to be a large scale. Will have to be a large scale hold, buy and hold, right? But look,
It would
what I'm
have to be a
talking about
large
is,
scale hold.
yeah. But what I'm talking about is, look, as long as the economy is growing, and as long as the company is doing well, and of course that means, you need to buy a company with good fundamentals, strong fundamentals, and so one good example is Apple, right? Look, Apple went public first, right? For the first time, Apple went public in 1981. It was actually December of 1980. But so that was already end of 1980. So that's a practically they went public, and their stocks got started to trade in the market since 1981. It's been 40 years. Over the 40-year time, do you know how much Apple grew? Do
Apple
you,
is, I think about like a 2 point something. I want to say 2.5 trillion right now. They got to be at like 2.5 trillion or something market
yeah,
cap.
but so no. Let's talk let's talk in terms of return on investment. Look,
Mm.
if you had bought Apple in 1981, right? And the
What was it trading for in
capitalization doesn't
1981?
tell you. Market capitalization doesn't tell you exactly. Market capitalization doesn't tell you exactly uh, how much it grew. I mean, in terms, it can only give you the size of the equity, right? Market size of the market value of the equity. It doesn't tell you if you had one share of Apple back in 81, and still one share of Apple today. It does, doesn't matter. You can scale up. You can scale it up. If you have 1,000 shares of Apple back in '81, and 1,000 shares of Apple today, it doesn't matter. One share or 1,000 shares, the return is the same thing because it's the ratio. But do you know how much it has grown over 40 years? Hmm?
I just did the math just now. I want to say 1,520%. It was 10
No,
cents.
no, no. Not percent. It was 1,500 times. It grew 1,500 times. That in percentage, you
1,500
would
times.
add two more
Wow.
zeros.
Oh,
Two
so
more
two more
zeros.
zeros.
So
Wow. Okay.
yeah. And back in '81,
Yeah.
it was the IPO price was only about $10. Okay, and so we are digressing again. Don't. I want to show you, but because I know I don't. This is the whole life of Apple, right? And then this was '81. It is now. We're saying it's $152 now. But then it's actually and then if you go back to this January of 1981, you would see 10 cents, something like 10 cents. No, actually at the time there has been
You're right. You're right. You're absolutely right. It's like around 10, 16 cents going into
yeah
1981.
no, but it's been adjusted. It's been prorated for splits because Apple had about 4 or 5, at least more than 5 splits over the span of 10 years. That's not that many splits, but most recent split was back last year, August 2020. They had a 4-to-1 split, and the one before that was in
Professor, I always wonder, why do splits happen?
Because splits make think about it. If they didn't split, Apple's share price by now would be $15,000 by now. 15,000. You understand? It grew
Yeah.
or $15,000 because it grew 1,500 times. And if a stock is $15,000, then will it be marketable? The thing is, if I have $1,000, if I have only $5,000, right? Let's say if I have $1,000, and if the stock price is $100, I can buy 10 shares, right? But if the stock price is $1,000, I can buy only 1 share. But then think about it. It's if the stock price is $1,000 and I buy 1 share only, then if I need $200 urgently, can I cash out conveniently only $200? I can't do that.
Can't do that.
I have to build the entire stock just because of that $200, right? You understand? So, but I only need to cash out $200, and I want to keep the $800 still in the stock. So I would realize return. I would get return from that, capital gains from that. But if it is $1,000, there's no way I can do that. I will have to sell it. So that means I will miss out on the opportunity for my $800 to earn the return, right? That would otherwise I would have made. You understand? So if the stock is, think about it. If Apple is $15,000 today, then it would be very it will be very burdensome for me to buy Apple, right? Because you have to have at least $20,000 just to buy one share of Apple.
That's like trying to buy Bitcoin right now. Bitcoin's so high,
Right,
it
right,
doesn't
right,
make sense.
right.
Might as well buy
And
something
Bitcoin is just
cheaper.
pumped up. Bitcoin is just pumped up. It has no basis, no fundamentals. And so think about it. Most people generally, I said, buy and hold strategy. Most people rely on buy and hold strategy, and because most people are not as sophisticated or not as well equipped to play it like the hedge funds, right? So the most people will be always at the losing end, right? And in the long run, stock market is not a zero-sum game. Stock market in the long run is a positive sum game, but in the short run, stock market is a zero-sum game. What does that mean? If there's a winner, there's a loser, and winners win, winners gain is losers loss. You understand? That's why the short squeeze. That's why there's a short squeeze. That's why those hedge funds are
That's why the
trying
hedge fund
to
packing up their boxes.
exactly. They are trying to they want to take advantage of you, right? In the short run, the short run is a zero sum, right? Somebody has to lose, for someone to gain. So the thing is, most people are relying on long strategy, buy and hold, right? And then if to be um, to have peace in mind and to minimize risk, you have to, of course, you have to do the fundamental analysis. In other words, you have to invest in a company that has strong fundamentals. Strong fundamentals. Then it's a company like Apple, right? And look, that again, took us, around long way around. But so return. Now think about it. Return is the return on investment is the single most important reason you are studying finance. But return is not the only factor, because you can first of all, return is percentage. Always return, rate of return. It's a rate of return, so it's percentage. It has to be. Now, let me give you an example. So you bought this stock, company X, that was $100 a year ago, and a year later the price is 150. So you sold it. Okay. So then, what is your return? And some people would say, I made $50. No, $50, that's in colloquialism, in spoken language. Yeah, $50, they say that's the return, but actually a better terminology is, $50 is either profit or capital gains, or proceeds, right? As I said, in a spoken language, they just call it return, but return, and there isn't, there's no law that puts you into jail if you call that, if you call $50 return, right? You're not violating any law, right? You're not violating any law. But then return is in more formal sense. Return has to be expressed in return means rate of return, and it must be expressed in percentage. Why? Because if you bought, look, in this case, your return is 50%, isn't it right? A year ago it was 100, you bought it, and you sold it a year later at 150. Yeah. So you realized return of 50%. Now, in dollars, that was $50, and that's, I told you, that's either a capital gain or profit. But then, suppose your friend had bought a $1,000 stock a year ago, and this year he sold it for 1,200. So what's his, profit, or what's his, capital gains? He made, $200 capital gains. And if you just call it return, yeah, his return is $200 and your return is $50. I mean, in colloquialism, you just call it return. Who do you think, what does it look like? What does it make you look like? Who did better? I mean, if you call, $200 and $50 whole return, then obviously he did better. It looks like he did better. But actually, who did better? You did better, isn't it right? Because your rate of return is 50%, his rate of return is only 20%. Isn't it right?
Facts.
So does that make sense why we have to express return in percentage, right? So return must be, return means rate of return, right? And when we say return on investment, it's always rate of return. Okay? In that sense, interest rate is also a rate of return, although it's, if you put your money in the bank, it's very safe investment, although it's very, mediocre, but, you don't even make, 1% on, your savings account, right? By today's standards, you don't even make 1%, you're making 0.1%. But it is riskless. But on the other hand, if you invest in stocks, it's highly risky. Okay. Now there are two types of returns. Of course, it's not really two different returns. It's just the in terms of whether you have standardized holding period or non-standardized holding period. First of all, holding period return. Holding period return literally means the return over the holding period of the asset. So the holding period may vary, right? Holding period may vary. Holding period can be 10 years or 5 years or 3 years, even months, a couple of months, or even a few days, or even for a few minutes or few seconds for day traders. You know what day traders are, right? Day traders are short-term investors who hold the asset for a very, short.
Could be minutes, could be hours. Sometimes they
It could
call
be hours.
scalpers.
It could even be minutes. They just buy and sell, buy and sell. They just do multiple trades during the day, just as long as they make a few, bucks, a few percentage return, between the time they, during that holding period. Now, but some that frequent trading strategy may work. It may look like it works sometime, but actually, if you compare, I mean, holding it long for you don't do frequent trading, but buy and hold for 1 month, 3 months, 6 months, right? And then if you compare two strategies, one, holding it for long term, and long term is actually longer than 1 year. It's 3 months or
Like
6 months is not
3
long, but compared to day trading, definitely, unless you have the patience to make that observation for 1 year or longer than 1 year. Let's just try 1 quarter at least, right? Holding for 1 quarter or 2 quarters, and during that period, another strategy, day trader, and let this person, let this day trader, trade as frequently as he wants or she wants, and then this person will buy and sell multiple times during the day, and on a particular day, maybe he seems to have outdone the long-term investor, but another day he completely
He gets wrecked.
Is
He gets
yeah,
completely
he's
wrecked. He
wrecked.
goes
And
down
another day
30%.
he recovers. Another day he's in a wreck again. And if over the same observation period, right, like 1 quarter or 2 quarters, eventually day traders don't do much any better than long-term investors, long-term strategy, right? And again, it just averages out, because if a long-term trader picks, a stock picking is, irrelevant, there's modern portfolio theory, but still, if you um, uh, if you select the undervalued stocks, right, and carefully uh, select undervalued stocks from different other industries, and of course with good fundamentals. I mean, undervalued means uh, they have good fundamentals, but the price isn't reflecting that. So if you construct a portfolio, well diversified portfolio uh, of these undervalued stocks, and hold it for like a quarter, 2 quarters, or 1 year, uh, it follows, that portfolio tracks the performance of those companies with strong fundamentals, and companies with strong fundamentals are bound to grow. But the day trader, they don't care. Day traders don't care. They just see whatever is ticking, price, upticks in the price movement. They just buy and sell and buy and sell. At first, it may look like you're doing well, but eventually it just averages out. And if they don't particularly do if they don't because they are just following the upticks, they are not doing the research of the fundamentals of the company. Eventually, those all those upticks and downticks, they will all average out, and eventually they will end up not doing better than the long-term strategy. Okay, and then another thing is, if there is a unusual uptick and a drastic upward movement in the price, uh, and without any valid reasons. In other words, this company doesn't have good fundamentals, but suddenly the prices, they're being hiked up. Prices, hiked up. What do you think is the reason? It's because somebody's pumping up the price. And who's pumping up the price? Right? Those
That's exactly what's
market manipulators. And then when the price is, unsupported, right? When the price is in, in the range, that is no longer supportable by the fundamentals, then they know, because they deliberately pumped it up. They sell it off there. They sell off.
to make retail pay more. They want you to pay more for it, and then after they sell.
And the backholders are really, being, pulled
waiting
down
for it to come back. They're waiting for it to come back to when they got it.
So look, and day traders, they don't care. They just if they see these upticks, they buy, and of course if they buy and sell at the right timing, good. They are, but what if they just bought, and that's the time when these market manipulators are selling off massively. They are they initiate massive sell-off, and you miss the timing, and then you'll be holding on to the stock that has no nosedive, right? So again, there are many smart Alex in the market, right? There are many smart Alex in the market who are mainly, day trading, and they think they are outdoing the market. No, eventually you can buy, short, buy, day trading strategy. You can't outdo the market. You can just do just about at best, just about as just about the market. You can do just about as well as the market, no better, no worse, at best. But if you have a long strategy, buy and hold, in a companies with strong fundamentals, you will outdo the market in the long run. Okay, so anyway, so here let's wrap this up because we cannot we spent digressed a lot already, spent too much time. First of all, so holding period return is simply defined as price at time t plus 1 minus price at time t. That t is the time subscript. Time subscript means, it simply means, that's the, and it's always the price at the end of the period, the closing price. Why? Look, so if t is always now, t is now. Now, when is now? When is now? Of course, for us it is August 31st, right, 2021. But if this is annual data, we don't have the price and it has to be the price at the end of the year. And the price of the end of 2021, we don't have that data yet because we're not there yet, right? And why closing price? Why is the price at the end of the year? Look, we will have at any given trading period, right? If it is annual data, in 2021, there will be 4 price points, right? 4 price points. Opening, right? The beginning, high, low, and end, closing. Now, during 2021, there was a price that opened, right, at the beginning of the year, opening price. That was, like January 1st. Of course, January 1st is a holiday, so market doesn't open. But let's just simplify everything, and a market opens on January 1st, and opening price during the year. There must have been a highest point, and during the year there must have been the lowest point. And at the end, as the market closes, there will be a end of the year price. Now, also during this day, it's the same thing. You have the beginning opening of the market, right? 9:30 the market opens, 3:30 market closes. So there's opening price and closing price. During the day, there's high and there's low. But what matters the most is, think about it, what matters the most is what do you think is the price point that matters the most?
The closing price.
Closing price, yes, of course. Yes, of course.
So the
Why?
next day,
Yeah. And this
so
is
the
Peter?
next day they know.
Yeah.
Yes.
Is this Peter?
Yes, it is.
Peter? Okay. Peter, you'll get 0.25 for answering that question. Okay. This is section 1400. Yeah. Because everything else doesn't matter, because opening price, high, low, they don't matter. Why? Because closing price is the conclusion of the trading of the day. Closing price is the conclusion of all transactions during the trading of the day. Isn't that right? Conclusion is what matters. It doesn't matter where it opened or how high it reached. Just the same. if we are dealing with annual price data, right? End of the year price is the conclusion of that year. Of course, we don't have 2021 end of the year data, price data. But then we have end of the year, 2020 end of the year. But so that is price at time zero. Why? Zero is the beginning. Zero is the beginning of the timeline. Time zero is the beginning of the timeline. And then think about it. Well, end of the year 2020, how can it be the beginning of timeline? Well, because think about it. End of 2020 is the same thing as end of December.
Start of 2021.
Yeah, it's the same thing as the beginning of 2021. Because think about it. End of 2020 is December 31st, 12 midnight. But 12 midnight is the 0 hour, right? 12 midnight is the 0 hour of January 1st of 2021. So then think about it. End of the year 2020 can be used as the data for beginning of the year for 2021. So that's price at time zero, because that's the beginning of our timeline. And then n means any random number. So it can, let's say our n is 10. So that means price 10 years later, PT plus 10, price 10 years later. Of course, we don't have, this is future, 10 years into the future, we don't have that data. So then we can move this back. We can move this back 10 years into the past. Then this will be PT minus N, PT minus 10, and this will be PT. So in other words, what was the price of our stock 10 years ago? We have the data. It's there. And what is the price at P0? We have the data. So then the difference between the two is the capital gains. Now think about it. The earlier example I gave you about, the company X, stock of company X, you paid $100 a year ago, and a year later you sell it for $150. So you made $50 what? $50 capital gains. Okay, $50 capital gains. And then so you will, to calculate the return, you will need to, if this is 10 years, the holding period is 10 years. This will be the capital gains over 10 years, right? Because holding period is 10 years. And this is the initial price, initial investment 10 years ago, right? So that will give you the return. I mean, if it is 1 year, that will give you 50% return. But what is this? This is the sum, that's the summation notation, sum of all the cash flows between time 0 and time n. So from, running from 0 to n. So if n is 10 over 10 years, what would be additional cash flow if it is the stock? Anybody? If this is the stock, the cash
dividend.
flow, dividend, yes. But then dividends, so Peter, I will give you another 0.25 points for that, answering that. But the dividends are not an obligation. Dividends are not an obligation. Some companies pay dividends, some companies don't. And you look at, if you look over the look at the history of Apple, between 1995 and 2010, for about 15 years, they didn't pay any dividends. And the company that is growing, they need to plow back everything into their growth. They have to, so they don't pay out dividends. So some companies don't pay out dividends, some companies do, and so sometimes this can be zero for even 10 years. This could be, so then this term drops out. In case of bond, additional cash flow during the holding period is what? is interest, coupon interest. Bond pays interest, and interest is an obligation. So it is. There's no uncertainty about the interest in case of bond. But anyway, that's how you calculate the return. The only thing is, then, because I gave you an example, what if the holding periods are different? Yeah, if the holding periods are different, right? Most of the times, the longer you hold an asset, of course, with the strong fundamentals. If it has, if there's a company with, very weak fundamentals, you cannot expect the price to grow. But usually, with the good company with, good fundamentals, they will grow over time. There will be definitely capital gains. But, because the holding periods are different, it's going to be, you cannot directly compare them. It's going to be like apples and oranges. So what do you need to do? You will need to annualize. In other words, you have to turn every return onto annual basis. An annualized return is sort of like an average. The term is, annualized is actually technically different from annual return. Why? Because annual return means the data is already provided as annual price data. In other words, every year at the end of the year, you collect the data and you provide it data. So it's already, year to year, right? The data is already, but then annualized means, regardless of the holding period, right? I mean, you can hold it for 30 days or 60 days or even 10 days. Now, look, if you held a stock for 30 days and you got, 10% return over 30 days, and how would you turn it into annual basis? You might think, oh, because it was 30 days, that's 1/12 of months, probably 10% times 12. Yeah, well, the reasoning is kind of right, but also it's wrong. Why? When you have just 1 month data, and you cannot just multiply it by 12. I mean, to do that, you will need to have like at least like data for a monthly data for the last 5 years, right? Including the most current recent month that you held that stock, and then 30, so you get the monthly data for the last 5 years. Then you have 60 data points. Then you can find average of those monthly returns, and then you can raise it to 12. You can annualize it. But again, we already know. Yeah, we're almost out of time because the class is until 3:15, so we are 5 minutes past the our closing time. So we're gonna continue, right? We're gonna continue on Thursday. Okay, so I will have to I'll have to stop recording and say goodbye to everyone. Take care and stay safe. And I will see you guys all back at 2 o'clock Thursday.
Thank you,
All right?
Professor.
All right.
All right,
Take
thank
care,
you,
Eva.
Thank you, Professor. See you
Bye.
Thursday.
Bye, class.
Yeah. Edgar,
Bye, everyone.
Eva, take care.